Hello and welcome to our next episode of Real Estate Talks. Today I'm joined by Ben Green, the CEO of Atrato Partners, which manages the supermarket income REIT. Hi, Ben.
Hi, Rogerio. How are you?
Very well, thank you. So, as you all know, our long income fund invests in UK long leased properties, and the supermarkets represents about 10% of our allocation. So how we ended up investing in supermarkets is also thanks to Ben, who explained to us the basics of investing in this asset class. So we thought to invite Ben to this mini series of 30 minutes and talk to us about supermarket. So Ben, supermarkets are typically seen as part of the retail sector facing secular headwinds due to the rise of e-commerce. So what is the attraction of supermarkets as a standalone investment strategy?
Yeah, it's a great question, actually. And the fact is that e-commerce or online impacts grocery in a very different way to non-food. So non-food is typically fulfilled from a central warehouse. And of course, they can leave the package on your doorstep, when you're out. It's relatively simple from a logistics point of view, but grocery is really complicated for many reasons. And they have to make sure they maintain the right temperature during the delivery because they have frozen and chilled as well as room temperature things to deliver to you. And also typically you need to be in as a customer to receive your grocery order. And that means they have to hit a timed delivery slot because, you're not willing to sit around all morning waiting for the delivery, right? You want to know that it's going to arrive between 10 and 11. What that means is that actually you need to use distribution hubs that are really close to your customers. And of course, the supermarkets are really close to their customers already because they designed these sites so that they were really convenient for customers to drive to or walk to in the first place. It means actually, it turns out they're in the perfect location as last mile delivery hubs for online grocery. So, just to give you an example, in the UK during COVID, we've seen online grocery penetration double from about 8% to around 15%. And the sales in the stores that we manage have actually gone up significantly, right? And that's because all those online sales are actually going through those stores. That's very different in non-food retail, where you could imagine like online non-food has also grown massively, but of course that's been while the stores are closed, right? So you can clearly, it's very easy to see how you can do non-food without a store. In food, you just absolutely need a store. And that's the really big distinction.
Understood. But can you give us a bit more color of the UK grocery market? So who are the key players and what are the main dynamics?
Yeah, absolutely. So 70% of the UK market is basically four players, roughly. Anyway, so Tesco's has about 30% market share. Sainsbury's and Asda each have about 15% market share. And Morrison's, which has been in the news a lot this week, has about 10% market share. And we call them kind of the big four players. And then you also have some people who are building market share, the discounters. So Aldi and Lidl, between them, have about 15% market share. And that's the bulk of the grocery market.
I lived in the UK from 1996 to 2009. Okay, and I remember I was living in Docklands. Okay, mm-hmm. I remember that suddenly they built a big Asda over there.
Yeah,
and
I know
there
that
was something it was referred to as the space race.
Yeah,
okay,
absolutely.
So there was a frenzy of opening supermarkets. So what was going on at that time?
Yeah, so there was a kind of a land grab by the big grocers to find the best sites and to build out. And it was a period where grocery was consolidating into these bigger stores. So they'd build a store, and literally the trade would come to them. And so actually, what a lot of the time what you find when you look at grocery stores actually is that they bought the best site in town, right? Or actually, if you look at a typical regional town in the UK, you have the town in the middle, you have a road that runs around it, and then what you'll find is on one of the junctions to that ring road, there's a Tesco's on one side, and then on the other side it's a Sainsbury's, right? And those are the kind of the best sites in town. Now, the space race was great, right? While there was still room to expand, grocery market share, and what they were doing was basically taking share from all the independent operators to grow into this position.
This corner shop that then disappeared.
Yeah, exactly. And small independent chains of supermarkets, and they all got kind of swallowed up. And what you find with all these kinds of things, it's like a super tanker, right? They had this strategy, and everybody at the organizations was behind it, and it just went on for too long at the end. So they kind of overran the finishing line, right, on the race for space. And so what we found when we got to kind of 2015 was actually that, they built a few supermarkets that they didn't need. And that actually created a really good investment opportunity for you and for us, right? Which is that there was a perception that there was too much space then in supermarkets in the UK. Now, in reality, most of their excess space got closed down pretty quickly in 2015, 2016. And what we're seeing now, interestingly, is that actually they are selectively building new sites as infills. So I think that's a really good kind of macro for grocery. So grocery sales in the UK tend to grow in line with population, and the big four operators have built very little new space since 2015. So that's 6 years of not really adding any space, and that's just beginning to get to the point now where they need to add new space, which is a really good sign.
Yeah, a couple of months ago, one of the headlines crossed my screens that Sainsbury was just openly advertising for any landlord with a space for, particularly they were looking for, I guess, convenience.
Yes, yeah.
Format. So signaling that they are expanding.
Definitely.
But where has that left us with the big format, the superstore, the supermarket? I mean, is that still an important format, or there is a rethinking of the size of the format?
Yeah, so the interesting thing is that a lot of these bigger stores were originally built because they were designed to sell non-food and food. Mm-hmm. And of course, a lot of the non-food has gone online. And so, there in some of these bigger stores, there is excess space, or there was excess space. Now, interestingly, online has kind of provided a solution to that for grocery in the form of grocery. So they actually need more space now within these stores than they used to do the online grocery. So some of that is that they need more space to pick in the aisles. So they move the grocery aisles further apart and dedicate more of the store to grocery. And they also need more space out back as well. And of course, these big stores are in fantastic locations for online grocery because they're on a big piece of land. So there's lots of space to move the trucks around, lots of space to park the trucks. And they also have great transportation connections. So they're usually right on an arterial road. So they give you you have great population within a sort of 30-minute drive time of the store, which is exactly what you want for online. So we went through a period where there was a perception that there was too much space overall. That was kind of solved by them closing some stores, and that's kind of happened. And then we went through a period where there was a perception that some of these stores were too big. Mm-hmm. And again, actually, maybe that perception still exists, but actually the reality is that they need those stores for the online grocery. An online grocery has doubled over the last year in the UK, and the stores have been the solution.
Yeah, I was tracking some of the real-time data on food delivery, and on those counts, these numbers are printing 50% growth actually. But these are like not official numbers, just picking numbers from Google's. But what about the discounters? Okay, at some point, obviously, they posed a big threat to the large supermarkets. Are they still a threat? Are they offering an opportunities for supermarket investors?
Yeah, so again, that period up to kind of 2015, I think, was a period where the big four operators have got a bit lazy in their thinking, right? And I think they were caught out a little bit by the discounters. So the discounters are in the UK with predominantly Aldi and Lidl. And Aldi and Lidl are very good at providing a kind of a fairly basic, low-cost offer to consumers. You know, and that has proven to be quite attractive to UK consumers. And that between them, Aldi and Lidl have about a 15% market share. Now, what's interesting is actually historically, the UK has had about 20% market share for discounters. So actually, we're not kind of at peak discounter. That was actually more like the late 80s when we had the most discounters in the UK. But what's happened is actually we have much more cost-focused management teams come into the big four since 2015. They've really focused on driving costs out of the business. They've really focused on value for customers. And the value proposition now of the big four is pretty close to the discounters. And I think what we're seeing coming through in the numbers is that the discounters are really struggling to grow, like for like sales. They're growing space a bit, but we think maybe they top out at about 20% market share, and that's absolutely fine for everyone. It's kind of a valid channel, and as you say, it provides another interesting investment opportunity because they're opening lots of stores. They tend to be slightly smaller stores, but they usually come with a kind of a 15-year inflation-linked lease on them, which is a super attractive income stream for investors like us and you.
Understood. But what about on the opposite end, the pure online players like the Amazon, the Ocado? I mean, Amazon is not 100% pure online, but do they pose a threat to the big four, to the discounters?
Yeah, we don't think so, really. So I mean, so Ocado gets an awful lot of press in the UK because it's kind of exciting and it's tech. But actually, Ocado only has about 1.5% market share in the UK. And the challenge with that model is that you have to build very big, very expensive sheds so the Ocado model is to have a centralized distribution warehouse, try to put lots of robotics into it to make it efficient. And their picking solution is really good, right? So they're really good at putting the orders together.
Even the grocery, I mean, the robot can select the apples and the tomatoes.
Now, interestingly, that bit's done by hand still, actually. So
okay.
So there are actually still a lot of people at one of these places, right? Okay. But there's some pretty smart robotics. But the problem they have is that they then have to drive a long way to deliver it to the customers. And the problem is that driving is the piece that really kills your economics in grocery. So you can afford to be a bit less efficient on picking and packing. And the supermarkets, the big four, would do it from their own stores. But where you want to be really productive is on the drive. So, if you only have to drive 15 minutes to your first customer because you're driving from a local store, that's great. Whereas if you're using a centralized distribution shed, you might have to drive an hour or 90 minutes to your first customer. And you can't reduce that cost per hour effectively. So we don't think pure play makes a lot of sense. The other reason is actually, in the UK, lots of people drive, particularly once you get outside London. People actually quite like doing click and collect, where they go and pick up their groceries from the supermarket. And again, you can't do that with the pure play model because the warehouse is stuck somewhere on some industrial estate that nobody knows where it is. Amazon's a bit different because Amazon in the US already has a track record of buying physical grocery stores. They bought Whole Foods in the US in 2017. And they did that because they realized that this was the problem with grocery, right? That you need local last mile delivery hubs. And those hubs are best if they're actually stores. So if we were betting on it, I think we'd say that Amazon will end up buying one of the big UK grocery operators at some point. That's our, and maybe the news this week that Morrison's is in play maybe that puts Sainsbury's in play, right, for Amazon. It'd be a good match in terms of demographic.
Yeah, because I believe that Morrison's has already put the bulk of their products on the Amazon platform.
They have, yes, they have. But the interesting thing is actually that from a demographic point of view, Morrison's is not such a good fit for Amazon. Sainsbury's is a better fit. So I think we think that if Amazon were going to buy somebody, then maybe Sainsbury's is the one they go for. Obviously, can't get inside Mr. Bezos's head. If I could, I'd be very rich. But
Understood. We bought also one supermarket a couple of weeks ago. And since then, we have been flooded with with other deals. Oh, you want to buy the supermarket? You want to, and so the question is, obviously, we are not super expert. We had to seek also external advice. But is it like a buy proposition across the board, or as an investor, we should be selective on the thing? I mean, leaving aside the price, how do you really invest in this space? I mean, what should be really the top criteria?
Yeah, so fundamentally, what we're looking to do is to buy supermarkets where the business case for the site is sustainable. And so the question is, like, how do you underwrite the sustainability of the business case for the site? So you can do some sort of more, you could look at demographics around the store and competition and those kinds of things. You can look at store trading. So where does it sit in terms of the volume of trade it's doing, and also the sales densities that it's doing. But for bigger stores, we think the kind of really fundamental underpin to sustainability is what we call omni-channel, which means that it's a physical store, but it's also doing the online delivery as well. Because then you can be agnostic, right, as to how that channel shift happens. So I mean, we kind of think online will probably get to 20-25% penetration in grocery in the UK over the next decade. And if we own the bigger stores that are doing the online, then they're going to benefit from that. They're going to effectively take volume away from the stores that are not doing online. Discounters may be a little bit different, right? Discounters don't do any online, and they serve a demographic who are less likely to want to do online. So it's not quite so essential there. But for the big stores, we kind of think that's an essential part of underwriting the story.
Understood. And we typically have seen two types of leases. Some are open market rent reviews, and some are inflation linked. Which one do you like most?
Well, again, you just mentioned in the previous question, sort of price is obviously an issue, right? So, we really like the contracted rental uplifts that you get from inflation leases, because you have a predictable increase in rents, obviously depending on what inflation is. And we think the operators like those as well, because actually they can model what their rents are going to be going forwards. Those have become more expensive. When we started Supermarket Income REIT, there was a lot more value in those leases, and so we've sort of adjusted to look at some open market rent review deals. Now they're you're relying on growth in market rents, which hasn't been so strong, and so you don't have that sort of certainty of uplift. But if you're buying it at a cheap enough price, then on a relative value view, it looks like good value versus the inflation. So I think we'd always rather have contracted rental uplifts, but if that gets too expensive, then we absolutely don't mind having the open market rent reviews.
And one of the things that I noticed, as I said, looking at the deal flow, is that there are some supermarkets which are really over-rented. Now, I do not know exactly whether you should compare it to the next door or to a national average, but there were some supermarkets with a 36 pounds square foot, while from what I understood, it should be around 12, 13. That's the right price. How do you deal with the supermarkets which are heavily over-rented?
Yes, so I mean, I think the average sort of market rent in the UK would be kind of probably low 20s actually for good stores. Okay. So maybe kind of £22, £23 on really good stores. We think the right rent on the store should be based on trading again, and that should be kind of around about 4% of turnover is kind of the right rent. Now, if you're buying a store that's over rented versus that, then you have to think about what happens at the end of the lease, and basically you just have to get out Excel, right? And what's kind of quite nice in this space is that the real estate, the pure play real estate sort of community is not kind of as financially minded as you are and we are. So what you have to do is model. I have my rent's going to drop at the end. How much is it going to drop? Run some scenarios and make sure that fits your returns that you're underwriting. And we think we have a big advantage in that space for shorter leased assets. I mean, obviously, if you buy something with a 20-year lease, it's much less relevant because most of the value is in the cash flow that you've got contracted. If you buy something with a 5-year lease, it's a pretty immediate issue, right? So we think we have a big advantage in underwriting those ones with shorter leases because we have so much specialist knowledge within our business around how the operators look at these leases, how the store fits into their strategy, and kind of like what the rent ought to be. We can underwrite those re-gears and buy assets at prices that hit our returns. But the rent, if you buy something at 36 pounds per square foot with 5 years to go, the rent is going to come down at the end. So you just have to model it. You just have to figure out what that means for your purchase price.
So is there a strategy of investing in shorter lease properties with the view of re-gearing those?
Yes, yeah, absolutely. And I mean, I think that's the advantage of having a big portfolio with diversification. I think if you like the store you bought is on a very long lease, so that's definitely, if you're buying one store, you have to buy one on a long lease. I think if you've got 50 stores, then you can have a blend of maturities, and you never want to be in a position where you have to go and ask for the lease extension from the operator. The better position to be in is for them to have to come and ask us for the lease extension. If you only own one store, then at some point you're going to have to go and ask for the lease extension. Yeah. If you own 50 stores, we're going to wait for them to come and ask, and it's a much better place to start a negotiation, right?
True, and this is then my final question. Do you see them coming to you, to us, and asking to buy back their stores? I mean, it looks like these ideas of sell and leasebacks they were doing 10, 15 years ago, it didn't turn out to be a very good idea for many of them.
No, exactly. I mean, it's really interesting, isn't it? Because if you look at someone like a Tesco's, right? I mean, they can issue bonds at 2%.
We've even seen 1.4, 1.5.
Yeah, yeah,
on the screen.
yeah. And then if you take as an example, take a long lease with index linked uplifts at maybe like 4.5%
Starting, but then there is a 3% in 2.7, 2.8%.
Exactly. So they're effectively paying like a 6-7% cost of capital to have us fund that store for them, whereas they could fund it at 1.4%. So absolutely, for companies with strong balance sheets, the big change has been the change in accounting treatment, right? So a couple of years ago, IFRS 16 came in, and that means that all these leases are treated like debt on their balance sheet. And so now it forces them to take an economic view of leasing, whereas previously there was a little bit going on where they thought, well, if I do leasing, it's not debt on my balance sheet, so it's off balance sheet financing. Now it's all debt. They take an economic view of it, and definitely, I mean, Tesco's is the second biggest purchaser of supermarkets in the UK in the last 24 months. We definitely see that coming down the track with the others as well. So it's a really unusual sector, right? It's very unusual that you have a sector where one of the biggest tenants is actually one of the bigger buyers of assets. So we think that's a really positive tailwind for valuations in the space.
I mean, at least for us, we hope that they will come and exercise their option.
Absolutely.
Next year. That would be very nice. Very good. We are pretty much done with the time. So thank you very much, and we hope to see you soon.
Thank you, Rogerio. It's been a pleasure. Hopefully see you in person at some point in the not too distant future.
Exactly. Hopefully in September. Bye.
Bye.